Hello, myself Muhammad Abdul Nasir and my student ID is 2837124. I am pursuing my Master Management Science in Data Analytics specialization. So let's start this presentation with the following contents. Coming to the list of contents, we will study introduction, background, inventory transactions related to the cost of goods sold, typical journal entry and T accounts related to the above inventory transactions, adjusting entry affecting cost of goods sold and Parsis forecast, and recommendations and proposals in the presentation. And at last but not the least, we will end up the following presentation with the conclusion. Coming to the introduction, so adjusting entries are journal entries made at the end of the accounting period. So that and these accounts are not up to date. These entries ensure that the financial statements accurately reflect the company's financial position and performance. Examples of adjusting entries include depreciation, accruals, and prepayments. So to improve this financial forecasting, in the future, companies can use various methods such as the percentage of sales forecasting, straight line forecasting, moving average forecasting, and pro forma statements. It is essential to maintain data integrity, consider external influencers, consider all outcomes with scenario planning, take an lateral approach to forecast and backmark against competitors. So companies should also keep in mind their financial forecast flexibilities and reflect changes in their business. So coming to the inventory transactions that are related to the cost of goods sold. So inventory transactions are closely related to the cost of goods sold. We call it as COGS, and it is the cost of the company's product during a specific period. It includes the cost of materials, labor, and overhead used to produce the products. The cost of goods sold is calculated by subtracting the cost of the ending inventory from the sum of the cost of beginning inventory and the cost of goods purchased during the period. Recording material cost typically accumulate all the costs associated with producing a product. These costs include direct materials, direct labor, and manufacturing overhead. The cost of the material used in the production is recorded in the inventory account itself. So when the product is sold, the cost of the material is transferred to the inventory account to the and from the inventory account to the cost of goods sold account. This process ensures that the cost of the materials is directly matched with the revenue generated from the product sales. So typical journal entry and T accounts related to the inventory transaction is in this slide. So in the journal entry, we have four columns set as date, account, debit or credit. So we will write the following description about that, whether it is account receivable or service revenue, either debit or credit. And in this way we can balance the sheets. And this is the small example of the T accounts entry, T accounts entry into the inventory transaction. So balance purchased, example, some raw material inventory. So the balance is $15, purchase is of $245 and it is used. So balance is now $30. And we see if it is in work in progress inventory, then we see all the direct labor charges, manufacturing overhead, direct material and all, and we will the leftover balance is $40. So this is how the entry is made. So this is the sample. Coming to the next, adjusting entry affecting cost of goods sold and Parsis forecast. So an adjusting entry is a journal entry made at the end of the accounting period to update accounts that are not fully there, as we already know discussed into the introduction. So the adjusting and journal entry involves debiting inventory adjustment to reflect the actual inventory count and crediting COGS to rectify the overhead expense. In this case, the physical inventory count conducted at the end of the quarter determined that $3,050 $350 $50,000 of polyethylene was missing. The adjusting entry would be to debit the cost of the goods sold for $350,000 and credit the inventory account from $350,000. So this entry ensured that the cost of goods matches the revenue generated from the product sale. The Parsis forecast for the cost of goods sold would be off by $350,000 due to the missing inventory. This could affect Parsis' ability to create reliable financial forecast used by executives when they communicate with investors. So even a single dollar or like small amount of small amount can misbalance the sheets and the financial forecasting, and this might lead to the bad impressions towards the investors. So typical journal entry and T accounts related to the adjusting entry in the forecast. So here also we do have four columns: date, account, debit or credit, and this is related to the cost of goods sold and the inventory adjustment. And coming back to the T accounts, here we do have two columns. The one is for the inventory and is for the cost of goods sold account. So from here, credited some X amount and debited into this X amount on this particular dates. So we will keep these following things be ready. So coming to the recommendations and proposals after seeing the data of Parsis forecast and financial statements. So some of the recommendations are like what we can say, the point that we can put on the table is conduct frequent cycle counts of inventory to identify and address discrepancies, promptly reducing the reliance on less frequent physical counts. So we need to count everything, like some examples, like in some stores they count in the evening basis, some in the morning basis, like that we can keep an account, and implement advanced inventory management systems and technology solutions for real-time tracking and automatic updates, minimizing manual errors. Invest in comprehensive training programs for inventory management staff to ensure a deep understanding of accurate record keeping practices. Establish robust internal controls, including segregation of duties and regular reconciliation to monitor and verify inventory transactions effectively. And the last is the foster culture of continuous improvement, regularly reviewing and updating forecasting methods based on historical performance and feedback from discrepancies. Implementing these changes will fortify Parsis company inventory management practices, reducing the risk of forecasting errors and enhancing overall financial accuracy. Coming to the conclusion. So in conclusion, the forecasting is an essential part of any financial planning for any business, any kind of business. Accurate forecasting can help companies make informal decisions and prepare them for the better future. By debating inventory adjustment and creating the cost of goods sold, the correction aligns expenses with actual inventory values, including influencing Parsi's future financial projections. This meticulous adjustment not only rectifies past errors but also enhances the reliability for forecasting, ensuring that Parsi can make more informed decisions based on precise financial information and maintaining the integrity of its financial statements. By implementing these changes, companies can improve their forecasting accuracy and make more informed decisions about the businesses. So, before I end this presentation, I want to present a small quote by Danny Garnick. He says, accounting does not make corporate earnings or balance sheets more volatile. Accounting just increases the transparency of volatility in earnings. And any doubts, please let me know. Thank you.